Let me tell you about two cousins. Same family, same neighborhood, same starting point in life. The first cousin, let's call him Kevin, was always the sharp one. The one who read financial news at breakfast. The one who knew which crypto was about to moon, which tech stock was undervalued, which hot EPO was worth jumping into. Kevin was excited to talk about money. He had tips. He had insider knowledge. He had conviction. And for a while, honestly, it looked like Kevin was going to be absolutely fine. The second cousin, we'll call him Ray, was boring. Painfully, almost embarrassingly boring with money. Every single month, without fail, Ray put money into index fund. The same one, every month. No excitement, no hot tips, no portfolio reshuffling. He didn't check his investments every day. He barely talked about them. At family dinners, when Kevin was explaining his latest play, Ray would just nod quietly and change the subject. Fast forward 20 years. Kevin, the exciting one, the sharp one, had been through 3 major financial wipeouts: the crypto crash, a stock that went to zero, a can't-miss investment that I absolutely missed. His net worth today? Around $180,000. Not bad, but not what you'd expect from 2 decades of active, passionate investing. Ray boring, quiet, unexciting Ray never changed his strategy. Same index fund, every month, for 20 years. His net worth today? Just over $1.1 million. Ray isn't a genius. Ray didn't get lucky. Ray didn't have a secret. Ray just did something that almost nobody wants to do in a world that rewards excitement and punishes patience. He stayed boring, and boredom made him rich. Today, we are going all in on the boring investments that actually make people wealthy. Not the stuff that gets covered on financial news channel, not the crypto plays or meme stock or get rich quick scheme. The real stuff, the quiet stuff. The stuff that's been working for decades while everyone was distracted by the exciting stuff that usually doesn't. Grab your coffee, let's get into it. Before we get into the specific investment, I want to spend a few minutes talking about why boring work. Because I think if you understand the psychology behind this, everything else is going to click a lot faster. Here's the fundamental problem with exciting investment. Exciting investments are designed consciously or not to trigger your emotions. When you buy a hot stock or jump into the latest crypto craze, your brain gets a hit of dopamine, the same chemical that fires when you win at a casino, the same one that makes social media addictive. It feels good. It feels like action. It feels like you're doing something smart. But here's what that emotional engagement actually does to your financial decisions. It makes you buy high because excitement peaks when prices are already up and everyone is talking about it. It makes you sell low because panic peaks when prices are dropping and the news is terrifying. And it makes you trade too frequently because doing something always feels better than doing nothing, even when doing nothing is exactly the right move. The boring investments don't trigger that cycle. They're not exciting enough to make you panic sell. They're not thrilling enough to make you pile in at the peak. They just sit there, quietly growing, while your brain stays calm enough to leave them alone. There's a study by Fidelity Investments that became legendary in personal finance circles. Fidelity looked at which of their customers had the best investment return over a long period. And the accounts that performed the best, they belonged to people who had either forgotten they had an account or who were dead. Seriously, the accounts that were never touched, never traded, never reacted to market news, outperformed the actively managed ones by a significant margin. The best investment strategy is one you can stick to without emotional interference. And boring investments, almost by definition, are the ones you can actually stick to, because there's nothing to get excited about, nothing to panic about. You just keep going. Now let's talk about the actual investment, and I'm going to go through each one in real depth, not just buy index funds, but what they actually are, how they work, why they work, and what the real numbers look like over time. If there is one single investment that has quietly made more ordinary people wealthy than anything else in modern financial history, it is the index fund, and it is almost aggressively boring. So what is an index fund? At its core, an index fund is a collection of stocks that tracks a market index, the most famous being the S&P 500, which is made up of the 500 largest publicly traded companies in the United States. When you buy into an S&P 500 index fund, you're essentially buying a tiny piece of 500 companies at once. Apple, Microsoft, Amazon, Google, Johnson & Johnson, all of them in one simple investment. You're not betting on one company. You're betting on the entire American economy. And historically, over every long time period, we have data for that bet has paid off. Here's what the numbers actually look like. The S&P 500, on average, has returned approximately 10% per year before inflation, or about 7% after accounting for inflation over the last 100 years. That includes the Great Depression, both world wars, the 2008 financial crisis, the COVID crash. Every single disaster, every recession, every market panic, and the long-term average is still around 10% annually. Now let's put that in real human terms. If you invest $400 a month into an S&P 500 index fund starting at age 25 and you average 8% annual returns, slightly conservative, by age 65, you will have contributed $192,000 of your own money, and your portfolio will be worth approximately $1.4 million. You turned $192,000 $100,000 into $1.4 million by doing absolutely nothing exciting, just buying and holding every month for 40 years. Here's what makes index funds so powerful beyond just the returns. The fees are incredibly low. An actively managed mutual fund where a team of analysts picks stocks might charge 1% to 1.5% in annual fees. That sounds small, but over 30 years, that fee difference can eat up hundreds of thousands of dollars of your return. A basic index fund from Vanguard or Fidelity charges as little as 0.03% annually. That's 3 cents per $100 invested per year. The math of low fees compounding over decades is genuinely staggering. And here's the other thing that makes index funds beautifully boring. They require almost no decision making. You don't need to research companies. You don't need to read earnings reports. You don't need to watch financial news. You just automate a monthly contribution and let it run. The boring part is actually the feature, not the bug. Warren Buffett, one of the greatest stock pickers in history, has said publicly that when he dies, his instructions to the trustee managing money for his wife are to put 90% of it in a low-cost S&P 500 index fund. If that's good enough for Buffett's family, it's probably good enough for the rest of us. The second boring investment is one that has been building generational wealth since long before the stock market existed: real estate. And before you say I can't afford to buy property, stick with me, because we're going to cover both traditional real estate and a way to invest in it with as little as a few $100s. Let's start with the traditional version. Buying a home, specifically a modest, reasonably priced home, and holding it for decades is one of the most reliable wealth-building tools that exist. Not because real estate always skyrockets in value, though in many markets it does, but because of what happens when you combine modest appreciation with something called forced saving. Here's what I mean. When you pay rent, that money is gone. Full stop. It goes to your landlord, it builds their wealth, and you have nothing to show for it. When you pay a mortgage, a portion of every payment goes toward paying down the principal, the actual loan balance. You're building equity. You're owning more of your home with every payment. Even if the home never increases in value at all, after 30 years of mortgage payment, you own it outright. You have a major asset with no monthly debt on it. Now add in the fact that home values in most markets have historically appreciated at about 3% to 4% annually over the long term, and that you've also been building equity through payments, and you're looking at a wealth building engine that has made ordinary middle-class families rich for generations. Let me give you a real example. In 1994, a typical house in a mid-sized American city cost around $130,000. By 2024, 30 years later, that same house in the same city is worth approximately $380,000. That homeowner didn't do anything special. They just lived there, paid their mortgage every month, and held on. And they accumulated over $250,000 in wealth from a simple, boring decision made 3 decades ago. Now here's the version that doesn't require you to buy a house. REITs, Real Estate Investment Trust. A REIT is a company that owns and operates income producing real estate office buildings, apartment complexes, shopping centers, warehouses, hospitals, and it's required by law to distribute at least 90% of its taxable income to shareholders as dividend. When you buy a REIT through a brokerage account, you're investing in real estate same way you invest in stocks. No landlord headaches, no property management, no massive down payment. You get exposure to real estate return, and you collect dividend income along the way. REITs have historically returned around 10 to 12% annually when you factor in both price appreciation and dividend. Boring? Absolutely powerful? Tremendously. I know what you're thinking when I say bond. You're thinking of something your grandparents talked about, something dusty and old and completely irrelevant to your financial life. And honestly, that reaction is exactly why bonds are so underrated and exactly why understanding them can give you a real edge. Here's what a bond actually is, in plain English. When you buy a bond, you are lending money to an entity, a government, a city, a corporation, and they agree to pay you interest for a set period of time, then return your original money at the end. That's it. You're the bank. They're the borrower. The U.S. government issues bonds called Treasury bonds. They are backed by the full faith of the U.S. government, which, whatever your political view, has never defaulted on its debt in over 200 years of history. When you buy a 10-year Treasury bond, you know exactly what you're getting. A fixed interest payment every 6 months for 10 years, and your principal back at the end. Now, bonds aren't going to make you rich on their own. Their returns are lower than stock. That's the trade-off for the stability and predictability they offer. But here's why they matter in a real wealth-building strategy. They balance your portfolio. When the stock market crashes, and it will crash repeatedly, over your investing lifetime, bond prices tend to hold steady or even rise. So a portfolio that's 80% stocks and 20% bonds doesn't just feel better during a downturn. It actually performs better over time, because you're less likely to panic sell during a crash when 20% of your portfolio hasn't moved. The classic balanced portfolio, often called the 60-40 portfolio, has delivered consistent, reliable returns for decades with significantly lower volatility than a pure stock portfolio. boring to talk about, boring to manage, genuinely effective at building wealth over time. I-bonds are worth a special mention here. These are inflation-protected savings bonds issued by the U.S. government. They adjust their interest rate based on inflation, which means in high inflation environments like the one many economies experienced in recent years, they can deliver very attractive returns with zero risk of losing your principal. Not the most exciting investment, possibly one of the smartest for the risk-averse portion of your portfolio. Now here's one that a lot of people don't even think of as an investment, but the retirement account structure itself might be the most powerful wealth-building tool available to ordinary people. Not because of what's inside it necessarily, but because of the tax advantages it wraps around your investment. Let's talk about the 401k first. If your employer offers a 401k with a match, and you are not contributing enough to get the full match, I need you to hear this clearly. You are leaving free money on the table. The employer match is an instant 50% or 100% return on the money you contribute, depending on your plan. There is no investment on earth that guarantees you that kind of immediate return. None. The 401k match is the single best financial move available to most working people, and a shocking number of people either don't participate or don't contribute enough to capture it fully. Beyond the match, the 401k gives you something called tax-deferred growth. The money you put in reduces your taxable income today. It grows without being taxed along the way, and you only pay taxes when you withdraw it in retirement, when you're likely in a lower tax bracket anyway. That tax deferral, compounded over 30 or 40 years, adds up to an enormous amount of additional wealth. Now the Roth IRA. This one works differently. You contribute after-tax dollars, so no upfront tax break, but everything inside a Roth IRA grows completely tax-free. Every dividend, every capital gain, every dollar of appreciation. And when you withdraw it in retirement, you pay zero taxes, not reduced tax. Zero. If you expect to be in a higher tax bracket in the future, or if you're young and your income is relatively low right now, the Roth IRA is one of the most powerful wealth-building tools that exist. Let me put numbers on this. A person who maxes out their Roth IRA, currently $7,000 per year, starting at age 22 and continuing until age 65, will have contributed $301,000 of their own money. At an average 8% annual return, that portfolio grows to approximately $2.8 million, tax-free, every single cent. No income tax on any of it in retirement. The Roth IRA has been called by many financial planners the closest thing to a legal cheat code in personal finance. It's also one of the most underutilized accounts in America. Boring name, boring concept, transformational outcome. Here's one that combines the best of boring with a genuinely satisfying outcome: dividend investing. And this one I want to spend real time on because I think it changes the way people think about wealth. A dividend is a portion of a company's profits paid out directly to shareholders on a regular basis, usually quarterly. When you own shares in a company that pays dividends, you receive actual cash payments just for holding the stock. You don't have to sell anything. You don't have to do anything. The money just shows up. Now on a per share basis, dividends sound small. A company might pay 50 cents per share per quarter. But here's where the math gets interesting. When you reinvest those dividends, automatically buying more shares with the cash you receive, you're participating in something called compounding at an accelerated rate. Every dividend payment buys more shares. More shares generate more dividends. More dividends buy even more shares. It is a snowball effect that becomes genuinely powerful over long time periods. There's a category of stocks called Dividend Aristocrats companies that have increased their dividend payment every single year for at least 25 consecutive years. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, these are not exciting companies. They make soda, shampoo, and bandages, but they have been paying and growing their dividends through recessions, wars, market crashes, and global pandemic for decades without interruption. An investor who bought $10,000 worth of Coca-Cola stock in 1990 and reinvested every dividend would have a position worth well over $100,000 today without ever contributing another dollar. The dividends did the work. The consistency did the work. The boredom did the work. The real dream of dividend investing, the thing that gets people genuinely excited about a boring strategy, is reaching what's called dividend income that covers your living expense. When the dividends your portfolio generates every month exceed what you need to live on, you have achieved a form of financial freedom that has nothing to do with your salary. You could stop working and your portfolio would still pay you every quarter for the rest of your life. Okay, so we've covered 5 genuinely powerful, genuinely boring investments: index fund, real estate and REIT, bonds, retirement accounts, dividend stock. Now let's talk about how they work together, because the magic isn't in any single one of them. It's in the combination. Think of a wealth-building portfolio like a house. The retirement accounts, your 401k and Roth IRA, are the foundation. They protect everything inside them from taxes and let compound growth work at maximum efficiency. You build those first, as aggressively as your income allows. Inside those accounts, you build the walls with index funds. Broad, diversified, low-cost index funds that give you exposure to hundreds or thousands of companies with minimal fees and minimal effort. This is your core, long-term growth engine. You add bonds, maybe 10 to 20% of your portfolio, depending on your age and risk tolerance, as the roof. They protect the structure during storms. They don't make the house beautiful, but they keep it standing when the weather gets bad. You add dividend stocks, individually selected or through a dividend-focused ETF, as the plumbing. They generate steady, reliable cash flow that you can reinvest during your wealth-building years and live on during your retirement years. And if it's accessible to you, real estate, either direct property ownership or REITs, is the land the house sits on. A separate asset class that provides diversification, inflation protection, and income that doesn't move in perfect correlation with the stock market. This portfolio is not going to make for exciting dinner conversation. Nobody is going to be amazed when you tell them your financial strategy. But in 20 years and 30 years, the results are going to speak for themselves, quietly, consistently, and in a language everyone understands. Net worth. The simple version of this, if you're just starting out, max your 401k contribution to at least capture any employer match. Open a Roth IRA and contribute as much as you can. Put everything in a low-cost total market or S&P 500 index fund. Automate the contribution. Do not touch it. Repeat every month for 20 years. You will be shocked at what you have. I want to spend a few minutes on this before we close, because I think it's the most important thing I'm going to say today. The real enemy of boring investing isn't the market. It isn't recessions or crashes or inflation. The real enemy is you. Or more specifically, your emotions, your impatience, and the world around you that constantly tries to convince you that boring isn't enough. Every time the market drops 20%, something inside you will say, sell everything. That feeling is the enemy, because the people who sold during the 2008 crash and waited on the sidelines, locked in their loss, and missed one of the greatest recoveries in stock market history. The people who did nothing, who stayed boring, came out the other side significantly wealthier. Every time someone tells you about their crypto gains or their hot stock pick that tripled, something inside you will say, maybe I'm missing out. That feeling is the enemy, because for every person who tells you about the crypto that tripled, there are 10 people who lost everything who aren't talking about it at Thanksgiving dinner. Every time your income goes up and your lifestyle tempts you to stop investing as aggressively, that feeling is the enemy, because the wealth gap between the person who keeps investing through a salary increase and the person who absorbs that raise into their lifestyle compounds into a massive difference over a decade. The discipline to stay boring, especially when everything around you is trying to be exciting, is genuinely one of the hardest skills in personal finance, and it's also the most valuable one. Because almost anyone can pick an index fund. Almost nobody can leave it alone for 20 years without second-guessing themselves. Remember Ray from the beginning of the video? His biggest financial skill wasn't picking the right investment. It was the ability to be boring in a world that rewards excitement. That's it. That was the whole secret. Here's the thing I want to leave you with today. Wealth is almost never built dramatically. It's not built in a single brilliant trade or a perfectly timed market move or a hot investment tip from someone at a party. It's built slowly, quietly, and consistently in ways that are so undramatic that most people never even notice it happening until suddenly the numbers are impossible to ignore. The boring investments we talked about today, index funds, real estate, bonds, retirement accounts, dividend stocks, they've been making ordinary people wealthy for decades. Not because they're complicated, not because they require genius, but because they work consistently, reliably, over time. And most people won't do them because they're not exciting enough to feel like winning. Don't let the noise pull you away from the signal. The signal is simple. Invest consistently in boring things. Let time do the work. And one day, maybe 20 years from now, you're going to look at your net worth and realize that being the most boring investor in the room was the smartest thing you ever did. If this video gave you something to think about, or even better, something to actually do, drop a comment below and tell me which of these boring investments you're going to start or double down on. I read every single one, and I genuinely love hearing from you. New here? This channel is your home for honest, no-nonsense personal finance content that actually helps you build real wealth, not just talk about it. Hit subscribe because you don't want to miss what's coming next. Until then, stay boring, stay consistent, and I will see you in the next one.